Hey guys, welcome back to Andrew Invest. Today I usually go through my portfolio and give you an update on it, but something else dropped which I think was really interesting, so I decided to make a video on it. That's Warren Buffett's annual letter to his investors. So without further ado, let's get straight into it. Warren Buffett usually sends an annual letter to his shareholders of Berkshire Hathaway every year, which contains his thoughts on the market, Berkshire's performance over the last year, and just general investing gems and advice. I usually pay attention to this, even though I'm not a Berkshire Hathaway shareholder, for those reasons above, the investing gems. And I just admire Warren Buffett. He's one of the greatest investors of all time, as we all know. And so we can learn a lot from him. Let's get into the letter itself, because I think the first page has some really interesting information about the performance of Berkshire Hathaway's share price versus the S&P 500, with dividends included, over the last 58 years. Now, it's 58 years because 1965 was when Berkshire Hathaway was first bought out by Warren Buffett himself. Now, in that time, the S&P 500 has had about a 9.9% return, which is pretty good, but Warren Buffett has doubled that at Berkshire Hathaway with a 19.8% return. Now, it might not seem like a huge difference to someone who's not well versed in investing, but a difference like that over time can make a giant difference, and we can see that by the total return of Berkshire Hathaway being 3.7 million% compared to the S&P 500, which only returned a 24.7 thousand%. That's 100 times difference. Also, this outperformance over such a long period of time really puts to bed the argument by many investors that it's impossible to beat the market and there's no point trying and you should just invest in an index fund. Now, while it is true for the vast majority of investors, it's impossible to beat the market. But I do think that if we follow some of the advice that Warren Buffett and value investing principles put in place, that we can actually maybe outperform the market by, a few percentage points. And that has a huge difference on your returns over the course of your investing lifetime. Now, Warren Buffett on many occasions has basically spoken about the difficulty of outperforming the market when you're managing the amount of money that he is. That's hundreds of billions of dollars worth. When you have that amount of money, you are basically moving the market itself by executing trades, by executing companies. Not to mention the fact that so many people will be trying to copy your trades. So how can you beat the market when that's the case? And many people have criticized Berkshire Hathaway as a stock for not outperforming the market over certain periods of time, especially the more recent past. Now, if we look at a graph of Berkshire's performance against the S&P 500 in a more visual way, we can actually see that even over the last decade, Berkshire has outperformed the S&P 500 by a significant amount, nearly 40% since 2013. And it's broadly tracked it for the rest of the time. So the critics of Warren Buffett are pretty much in the mud at this state. Let's move further down into the report itself and look at some of the comments that Warren Buffett has made. So on page 2, he basically speaks about the value of philanthropy and how, he's happy to be in charge of a company whose shareholders pretty much for the most part are philanthropic and they're not trying to hoard wealth for generations. They redistribute the wealth to charities, stuff like that. So obviously that's very interesting. I think that Warren Buffett definitely means it when he talks about philanthropy. He's pledged 99% of his wealth to go to charity when he dies, and that's certainly commendable. Next, he basically speaks about how Berkshire has two forms of investment. One, where they fully own companies, and two, where they take a passive stake in a company and basically let it do its thing. Many people actually misunderstand this fact and they think that Berkshire's passively held portfolio is its entire portfolio. And that leads to the misunderstanding of many people that think that Berkshire's money is 43% invested in Apple. Now, that's definitely not the case. They have a huge amount of money in Apple, and it's a big percentage of their total holdings, but it's only 43% of their passively held portfolio. So it's a really easy mistake to make, and don't make the same one, otherwise you'll sound like an idiot. So now we move on to some of the actual investing gems that I mentioned earlier. Warren Buffett basically speaks about how he and Charlie Munger are not stock pickers, they're business pickers. They effectively don't buy stocks so that they can sell them on for a higher price, buy them at low and sell it high. That's not why they're necessarily investing in businesses. It's because they want to invest in businesses with long-lasting, favorable economic characteristics and those that have trustworthy managers for the long term. Now, businesses that often have these two traits can be at very high valuations. As he later says, controlled businesses are a different breed. They sometimes command ridiculously higher prices than justified and are almost never available at bargain valuations. Unless under duress, the owner of a controlled business gives it no thought to selling at a panic type valuation. Now, I think this is a really interesting mindset to have, and it basically justifies buying amazing businesses which have higher PE multiples potentially, as long as their business characteristics are amazing. This kind of logic explains why Berkshire has purchased companies which would traditionally be thought of as having really high PE ratios by many value investors that you might see on YouTube. So, for example, Apple has a price to earnings multiple of 25, which is much higher than the S&P 500 average of around 15, and a forward PE of 23. It also has a giant stake in Coca-Cola, which has a 27 multiple and 25 forward earning based on forward earnings. Now these are really high. Why would Berkshire, hold such a stake in them if it's thinking about valuation only? It's because these companies have a really amazing business model. They're very sticky and they have a moat. Companies like this are never going to sell off that much, even in a giant recession, even when the rest of the market is selling off. Companies that have business fundamentals like this are always going to be valued at a much higher PE than other companies. So I think it's important to sometimes not always get stuck in the mindset of PE is the be all and end all. Now, bear in mind, this is not an excuse to justify companies like Palantir, which have ridiculously high price to earnings multiples. In fact, none, because it hasn't made a profit. When the company, is diluting the shares, and when it has no proven history of positive cash flows, things like that, it's more of a justification of buying into companies with big moats and histories of producing cash flow for their investors. Let's go back to the report. So Warren also speaks about the power of creative destruction and how its effect on the economy creates a bunch of loser companies which you really need to pay attention to. That's the risk of investing, where you could invest in a company that goes out of business due to something else effectively beating it. And in the long term, when you're picking stocks yourself, you really have to just pick a few winners in order to outperform the market. He basically goes on to talk about some of his most successful investments. For example, Coca-Cola. He bought it for $1.3 billion in 1994. At the time, the cash dividend was $75 million. And now, in 2022, the dividend was $704 million. So that nearly covers the entire cost of the company in 1994. Maybe over 2 years of that just the dividend. And like he goes on to say, they didn't have to do anything in order to get that dividend, just sit there and cash in a check. Finally, Warren Buffett launched an impassioned defense of stock buybacks. They've been a politically contentious issue for the last maybe 5 years or so. Elizabeth Warren from the Democrat Party once was quoted calling stock buybacks nothing but paper manipulation. I was actually on board with that view a few years ago, thinking that money could be better spent on R&D that sort of thing. But in practice, stock buybacks are no different to dividends in the fact that they reward shareholders for taking the risk of owning a company. And companies that do stock buybacks instead of R&D will go bankrupt eventually anyway. So why should the government get involved in these stock buybacks? Why should they be discouraged? In fact, stocks are issued by companies with no taxes, diluting shareholders on a very regular basis, and there's very little regulation around that. So how is a company actually buying their shares back any different? If a company is allowed to sell their shares, issue more shares, why is it not allowed to buy them back as well? And this is quite important because there's a act which has just gone into practice called the Inflation Reduction Act, which puts a 1% tax on all share buybacks, and this is certain to have a large impact on Berkshire in the future. Now, Berkshire speaks about how it repurchased 1.2% of the company's shares in 2022. It's not a huge amount, but that effectively returns 1.2% of your total ownership of Berkshire back to you. When the share count goes down, your interest in Berkshire's businesses goes up. And the real power of share buybacks is that they can be done by companies at value accretive prices, i.e. when Berkshire's, Warren Buffett thinks Berkshire is at a lower price than it should be, he can do share buybacks, and that offers more value to an investor than just a straight up dividend. When a company overpays for repurchases, then the shareholders lose. But if you invest in a good company which recognizes when it's overvalued and undervalued, you can actually benefit a huge amount from share buybacks. He also controversially says that when you are told that all repurchases are harmful to shareholders or to the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. Now, that's really interesting if it's a shot fired at Elizabeth Warren or someone else. Oh, and the reason why some who are against stock buybacks say that they're particularly beneficial to CEOs is because a lot of companies have price targets at which their CEOs are rewarded with more shares in that company or cash. You can see that with Tesla. When it hit a certain stock price for a certain period of time, he was given billions in Tesla stock. Now, Tesla's not a company that does share buybacks, but that general principle is why people might say that buybacks are only beneficial to CEOs. Last thing I'd like to draw to your attention is this paragraph here, where Warren Buffett basically condemns bold, imaginative accounting, which is basically the practice of manipulating a company's accounting figures to make investors think that a company is doing much better than it actually is. Now, this is basically done to defraud investors of money to run a company. And most of the companies doing this practice will be companies that are being run for employees' benefit and for the executive team's benefit, i.e. paying their salaries and paying them lots of stock-based compensation. This is a trend which has been increasing in recent times. There's a lot of companies doing this, and it's a worrying one. As shareholders yourselves, and myself as a shareholder, I think it's a worrying trend and something to be on the lookout for when you decide whether to invest in a company. Now, that's it for this video. I've really enjoyed going through this report. If you want to check it out yourself, please feel free. I'll leave a link in the description. And yeah, I'll see you guys next time. Thanks for watching.